What are VCs? Sometimes they are called VCs or venture capitalists or investors. In this lecture, we'll break down not only what a VC is, but also a little bit of history on venture investing and what status VCs invest in. The easy definition of a VC is someone who invests in companies in exchange for equity. They are like angel investors, but instead of investing their own money, VCs invest on behalf of their fund. Before we get into the stages of companies VCs invest in, let's take a quick look at the history of venture. Early on in the tech industry, it took a lot more. It was very capital intensive to release the first product. Venture capital could bring access to that large amount of cash needed as well as the needs, both monetary and otherwise. To build an early stage product, instead of needing 50 to 100 employees to launch the first product, we now see quite a few companies that were only 2 or 3 people when they launched their product. Look at Facebook, a very successful company now. It took less than $1 million to build the initial product. This explains why you see a lot more angels and angel investing in our current environment. Although the players have changed slightly in the last 30 years, venture capital processes really have not. VCs can invest at any point from early stage funding to late stage funding. In all stages, we generally see one lead VC who sets the terms of the funding round, and a few other VCs filling out the round. We'll continue to focus our course on early stage funding. After all, this course was designed to help you pitch your first investors. Remember? Let's take a closer look at the specific status or rounds VCs participate in. You'll notice I keep referencing the milestones associated with the rounds as well. Milestones help frame the stage of the company much better. First, the seed or angel rounds, also sometimes called the idea or product phase. Sometimes you will see a VC to participate in a seed round. We do this when there's a fantastic opportunity that we almost definitely want to participate in following rounds. It also allows us to get involved and help the company at the earliest stage. We generally see seed rounds between 500,000 to 2 million, but we are starting to see up to 3 or 4 million as well. Series A, or the traction phase. By this stage, the product market fit is more clear and additional capital is needed to scale growth. Series B, or the expansion phase. Here, go-to-market strategy has been proven. Capital is needed to expand the team and go for the gold. Investors will generally expect at least 1 million in revenue, or for you to be the number 1 or number 2 market position, plus a strong, mostly complete executive team by the time you're raising your Series B. In the Series C phase and beyond, or the growth phases, profitability should be within reach. Or there should be a very compelling argument for why investing to the point of continuing losses would build a larger company. We are starting to see more and more companies stay private longer due to the cost and new regulations of going public, like Uber and/or Airbnb. Knowing how OVC invests and what each stage looks like should help you build your roadmap. You will understand your business and the milestones for each stage. Now that you understand venture capital, angel investors, and VCs, and have a good understanding of the stages they invest in, you are ready to start planning your first investor meetings.